Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guests today are Gillian Telsignor, Head of ETF Distribution at JP Morgan Asset Management, and Alex Dryden, Global Macro Strategist at JP Morgan. We are talking about fixed income ETFs today, and JP Morgan has an excellent suite of bond ETFs, including one of the most popular actively managed bond ETFs. It's the JP Morgan Ultra Short Income ETF, ticker symbol JPST. Gillian and Alex, welcome to both of you.
Thank you for having us.
Thank you.
So I wanted to start with bond ETFs popularity. Simple question. So they have gathered about $115 billion year to date. So tell us why they are so popular this year.
They certainly have been, Nina, and I think when you say that number, 115 billion, it really is fairly stark when you think about where bond ETFs have come over the years. I think it's a couple things really leading to the flows that we've seen. Number one, I think it's uncertainty in bond markets, which I think Alex will certainly talk about as we go through our conversation today. But it wasn't so long ago that we saw a rate increase, and we're concerned that that was going to continue. And now here we sit in an environment where we're seeing rate cuts. And so we're spending a lot of time with our clients talking about their fixed income portfolios as they grapple, frankly, with how to position their clients in light of this uncertainty. And it's been really exciting for us, as you mentioned, our lineup is pretty robust as it relates to fixed income, and it's really been evolving. And we are able to offer solutions across many aspects of the fixed income markets to help our clients really solve for the needs of their clients. And I think second is fixed income ETFs have really changed the way we think about investing in fixed income. And what I mean by that is we've taken what is inherently an opaque market and brought it starkly into the light on exchange. And it allows investors to access markets like high yield and munis and emerging markets for just a few pennies of trading cost in most cases. And the way I think about it, it's really democratized access to these markets for all investors, regardless of their size. So I think the ecosystem has really changed with the evolution of fixed income ETFs. And I do believe that's one of the main reasons that you're starting to see such adoption in such huge numbers.
Excellent. So bonds had suffered last year as interest rates rose, but they have done very well this year, as you mentioned. And that's mainly because interest rates have plunged. And about $17 trillion in bonds in Europe and Japan have negative yields now. So compared to those negative yields, U.S. government bonds look really attractive. And also when markets are volatile, which has been the case of late, investors tend to flock to bonds. And Fed fund futures currently suggest about 90% probability of at least one more rate cut this year. What is your view? Do you expect more rate cuts by the Fed this year? So can the bond rally continue?
This is a good question, and it's certainly for front and foremost in investors' minds as we head into late 2019. We've seen two cuts out of the Federal Reserve so far this year. We expect another cut by the end of this year or maybe in early 2020, dependent on how economic data evolves. Now, how this feeds through into markets, however, is less clear. As you mentioned, the market is already pricing in about a 90% chance of an interest rate cut by the end of the year. Therefore, if the Fed deliver on that, bond yields may still remain quite unchanged as the Fed just delivers on what was expected. Instead, investors will therefore be looking for clues about how Fed policy is going to evolve in 2020. And on that front, there may be some disappointment. At the end of the day, economic data in the United States has been fairly solid, not particularly fantastic, but fairly solid so far. And therefore, the Fed will be reluctant to carry out further rate cuts as we move into 2020. With that in mind, the market may be therefore a little bit disappointed versus all of the easing that has happened in 2019.
So the S&P 500 now yields more than 1.8%, whereas the 10-year Treasury yield is just about 1.75%. So bonds do look a bit expensive now and not much income either. So many income-focused investors are looking at dividend-yielding stocks. So tell us how investors should position their bond portfolios in the current environment. Which areas of the bond market look attractive to you now?
It's a very good question. What we're encouraging investors to do at this late stage in the economic cycle is to be cautious with where they're putting their investments and focusing really on quality within their fixed income exposure. At the end of the day, fixed income's core responsibility is to provide the ballast and protection to the overall portfolio if we do hit any bouts of volatility.
Mhm.
And in this late cycle stage, with heightened political uncertainty, an unclear pathway on how the Federal Reserve is going to do going into 2020, I think right now investors should be focusing on quality. That means focusing on areas such as core U.S. government debt, municipal debt, and areas like mortgage-backed securities. Why these sectors? Well, they are typically negatively correlated with equity market performance. And therefore, if we do see any economic or political volatility that rocks equity markets, this core ballast or bubble pack that we've put into the portfolio in the form of this core bond exposure is going to provide some protection to the overall portfolio. I would be nervous about taking on too much risk in some of the higher yielding areas like emerging market debt and US high yield.
Okay, excellent. So most of the inflows into bond ETFs have gone into passive bond ETFs, which basically mirrors the trend in equity ETFs too. But I should add that actively managed bond ETFs have been growing at a faster pace. And in fact, active managers have had some success in outperforming some of the broad bond market indexes too. But most investors do not understand that bond markets work differently and market cap weighting doesn't actually make sense in the bond space. So tell us why active management makes more sense for bond ETFs.
Yeah, it's interesting. I think when I hear what you said there around the majority of the flows going into passive, it's something that I spend a lot of time thinking about. And really, when you boil it down, there's really just been a lack of choice. Because if you look at the broader market, broader asset management market industry, if you will, the majority of flows go into active products. So about $3.5 trillion in active across ETF and mutual funds. And about 1.2 trillion, almost $1.5 trillion in passive or these debtor-weighted indexes. And so ETFs, the passive ETFs, have really been the beneficiary of the bulk of the flows because there has been a lack of active ETF options. Now that's starting to change, and even if you just point to your point earlier, if you begin to point to that, whether it be JPST or some of the others in market, we are starting to see that shift. I mean, I think about what we've been able to do with JPST when we launched that product in May of 2017 to where we are today, raising $9.5 billion. I think it's just a testament to the fact that there are advisors out there that are looking for active management and value active management when it comes to fixed income in particular. So we're incredibly excited. If you look at our lineup, minus really just two products, that's JAG and JPMB, our products are all active. We're believers that we can leverage the expertise and the broader JP Morgan fixed income expertise and bring that to the ETF marketplace where there just really has been a lack of choice for investors.
Excellent. So the Fed began buying short-term Treasury debt this week, and they will start with $60 billion a month initially. And this was done basically to fix the extreme volatility in money markets that we saw last month. So I think some of our listeners would be interested in knowing what exactly happened in money markets last month, and will the Fed's purchase fix this problem?
Okay, so let's just take a step back and just consider what the repo markets actually are.
Right.
The repo markets are the overnight money market rate for banks to lend to one another on a very, very short-term basis, sometimes as short as literally overnight. So typically, if one bank has to balance their books because they've made a number of loans, what they'll do is they'll borrow from another bank who has an excess amount of savings. That bank will charge them some interest on that movement of capital from one bank to another for a short period of time. The repo rate, which is that interest rate, increased dramatically a couple of weeks ago in a very, very quick fashion. And this caught some investors off guard, and it sent some ripples through the market. Why do people get concerned? Well, this spike in repo rates was similar to what happened in the build-up to the financial crisis. And therefore, some people were pointing at this as a sign of stress and strain within the financial system. With all that being said, there are some big differences between what happened in 2007 and what occurred in the middle of September in 2019. One of the biggest differences is that this time around, the challenges within the repo markets have more to do with illiquidity than they do with insolvency. What do I mean by that? Well, back in 2007, repo rates spiked because banks had concern about the solvency of one another's assets and therefore became reluctant to lend to one another. Fast forward to today, and actually the challenges are much more around liquidity within the repo markets. There's some very large banks sitting across the United States who are just frankly unwilling to lend to other banks due to very expensive regulatory requirements. And what that means is that interest rates sometimes have to spike in order to entice people into the marketplace. Now, the good thing about the illiquidity rather than insolvency issue is that it is easier to resolve. And this is where the Federal Reserve has stepped in the last week, taking its place at the table and beginning to extend loans to banks in the overnight market rate in order to try and pacify and try and improve liquidity conditions on a day-to-day basis. And therefore, it's not as big a concern as it was back in 2007.
That was a great explanation. So I wanted to ask you also about global and emerging market bond ETFs, because I noticed that JP Morgan US dollars emerging market sovereign bond ETF, ticker symbol JPMB, is in fact one of the top performing bond ETFs among your lineup this year, and it has gained more than 15%. And you also have an international bond ETF. It's called the JP Morgan Global Bond Opportunities ETF, JPGB, which has gained about 11%. And you talked about emerging bond ETFs being a little bit expensive now. What do you think about other global bond ETFs?
So I think JPMB is one that has been particularly interesting. For us, it's really about what you're trying to achieve with your fixed income portfolio and really anchoring back on that. We have a structure of which it's a framework, if you will, of which we use to talk to clients about their fixed income portfolio. And, we think about something like global bonds, emerging markets as extended sector, as I think most people would, and reaching more for total return. And so I really do think it's what are you trying to achieve with that bond portfolio, which will help you allocate appropriately to whether it be global bonds, emerging market bonds, et cetera. I do think, though, if you think about JPMB, that was really our first foray into factor-based fixed income, which I think we're going to unpack a little bit more here shortly as we move through our conversation. So I won't jump into that right now necessarily. But it is something that I think is important because it's something that I think historically people have thought factor investing just begins and ends with equities, but we've actually taken a jump into that within fixed income. And as a result, you'll see something like JPMB is not something that's going to be exposed to Venezuelan bonds, as example. And so that is something that, as we're talking to clients, has really been a proof point as to how we've been able to, through really a quality lens, take a better eye to the emerging market bond space and create a portfolio that is going to be higher quality, if you will. And you've seen, obviously, the resulting performance. And I think it's very much in line with what Alex was saying in terms of quality within the fixed income portfolio.
Okay. So I also wanted to talk a little bit about the change in composition of the bond market and the most popular bond index, which is the Bloomberg Barclays U.S. Aggregate Bond Index, popularly known as the EGG. So the amount of debt rated in the lowest tier of investment grade, which is triple B, has soared, and AGG now has more than 14% triple B rated bonds. And the Fed has also actually warned about increasing risks in the credit markets. And in the event of a downturn in the economy, we could see a wave of downgrades to junk status from the lowest investment grade. So, could you talk a little bit about the changing composition and also if investors should worry about bond ETFs? Investors holding bond ETFs should worry at all about the possibility of triple B rated bond being
Yeah,
downgraded to junk.
it's such an important question, Nina. I think that generally speaking, investors understand, what a market cap weighted equity index is, right?
Mm-hmm.
But I don't think they understand how that differs in the dynamics from a bond index, a passive bond index, or a debtor weighted index. Within the market cap weighted equity index, the company's exposure within that index generally grows as the stock price increases relative to other stocks in the index. And that market capitalization drives the weighting. And it can lead to overweights in particular sectors or stocks in a given time, right? I think most people understand that.
Right.
If you move into the bond markets, I think what a lot of people don't understand is that the more debt that you have as a company or a country, the higher weighting you get in that index. Right? It just seems very counterintuitive. And this is a very popular approach to gaining core fixed income exposure. Right? And that index that you mentioned has historically served as that ballast in the portfolio, but that has really dramatically changed. And as you mentioned, one of the most significant changes that it would be a bit of a surprise to investors is that it's been the expansion of that corporate sector. And so there's been this rapid growth in corporate debt issuance that's really caused that expansion. That corporate exposure is approximately 25% today of the index. That's up from roughly 17% in 2008. And it's actually a 35-year high. And the primary driver of that increase is, as you mentioned, the issuance of triple B rated bonds. That debt that's at the lowest end of the credit quality spectrum. And so that sector is driving a lot more risk than it ever has historically. And in this late market cycle, as you mentioned, I think that growing number of triple B rated securities that are on the threshold of being downgraded, we really believe that there is clearly room to improve upon this passive index approach. And that's essentially how JAG, our JP Morgan Aggregate Bond Index, was born. Bond Aggregate Fund was born. It's taking factor-based investing and extending it into fixed income. So while JPMB was technically the first, I think JAG is one that has been incredibly interesting to clients as they can really understand the changing composition of that index that has served as the ballast of their portfolio. And what we're doing with JAG is really just applying those factor screens just to the corporate issuers in that index, right? Precisely to solve the issue that you talked about and that I talked about, was looking at companies through the lens of value, quality, and momentum. So said differently, looking for undervalued companies with strong profitability, low leverage, and then positive recent performance in their credit and equity markets. And so it's just on that corporate sector that we're looking to improve. And then we duration match it back to the index. So it's a really much more thoughtful approach to that corporate sector without taking on large tracking error. And for 7 basis points, we hope to be able to deliver enhanced returns versus those heavily utilized, more traditional, passively managed exposures.
Okay, excellent. So in addition to JAG, JPMB also is a factor-based bond ETF, right?
It is. Those are the two that are run by our quantitative beta strategies team. They're the first, really, that we've put out. I don't believe will be the last. And you don't see them very often in the ETF industry at this point. It's not easy to create these products. It really is one of the key challenges being data. If you think about, GE as an example, if you want to buy GE equity, kind of the stock, right? GE equity. But if you go to buy a GE bond, there's tons of them. And so the ability to really harness and deal with that data has been a huge barrier to entry. And so the expertise that we have in factor investing and frankly, having a portfolio manager that we brought over to the firm that had managed strategies like this in the past, and he spent the last couple of years really working through this and developing JPMB, and then, of course, more specifically here to this conversation, JAG.
Excellent. Yeah, factor-based investing has become really popular in equity ETF world. It hasn't really taken off in the fixed income ETF world, and I think you mentioned some of the key challenges because of that reason. So, do you think it can become popular going forward?
I do. I think that investors are taking hold of their fixed income portfolios and trying to get a better understanding of what it is they own. Popping the hood, doing due diligence, understanding the changing dynamics of the index. We've spent a lot of time out there on education, just helping people understand, how the ag has changed, frankly, and bringing that to light, illuminating some of the challenges that I mentioned, and the fact that we do have that expertise, and we have this quantitative beta strategies platform that has done factor-based investing in equities, in alternatives, and now in fixed income for quite some time, is something that we've seen has been quite interesting to clients as they look for an improved ballast in the portfolio that brings a level of quality that they're not getting from other exposures necessarily.
Right. So while we are talking about bond ETF investing, we should try to dispel some of the myths about bond ETF investing. So there are myths like junk bond ETFs distort the bond market, and bond ETF liquidity may dry up during times of stress, and investors may not get a good price if they try to sell. So tell us about your take.
There are certainly a lot of myths out there, and in practice, the things that you talked about, we just haven't seen. ETFs are really a fraction of the overall bond market, and I think I would emphasize two main things for those that are listening. And the first one is because the exchange serves as that second layer of liquidity for ETFs. Meaning every time somebody's trading, it doesn't necessarily mean that individual securities or bonds in this case are actually trading hands. So buyers and sellers are exchanging shares on exchange, not necessarily trading bonds every time. So you and I could agree that we want to exchange shares of JAG or JPHY or any one of the fixed income ETFs, but we don't actually have to all the time tap that underlying market. In some fixed income ETFs, that ratio can be as high as 10 to 1. So what I mean by that is for every $10 traded, only $1 of bonds would actually trade hands. Now, I haven't looked at that exact stat in some time, but I think you know where I'm going directionally. Right. It's not always a 1-to-1 ratio, given the exchange-traded nature of ETFs. So not every dollar that trades in the ETF is going to mean $1 of bonds has to trade because of that exchange functionality. That is a real benefit. So we've seen historically, even during times of stress, to your point around the markets may dry up, I think during times of market stress, we've only seen volume increase on ETFs in general, and certainly fixed income ETFs included. I reflect back on a time like the financial crisis. There's any number of things that have happened since then, but really the financial crisis, it was then that investors who couldn't trade bonds started to look to ETFs as that outlet because they could buy and sell them and gain and remove exposure in a way that they just couldn't otherwise because of what was happening in the underlying markets. And so I think it really marked an important turning point for ETFs and fixed income ETFs in particular. And clearly, there's been extraordinary growth in these products in the last 10 years, and to the point that we talked earlier about $115 billion trading of growth just this year. I think the second thing that I would emphasize is just that the liquidity of an ETF is really just a function of the liquidity of that underlying market. Right. And so that means that it's really important to do your due diligence on the ETF that you're buying. Just like we talked about the importance of understanding what underlies the exposure itself. So understanding, for example, the composition of the ag or any composition of any index that you're buying. It's important to understand the liquidity of that underlying market because that's what can drive the liquidity of your ETF itself. And I would say that, at JP Morgan, we have an incredible capital markets desk that works with our clients every single day in helping them understand how best to execute, buy and sell in our ETFs. And I know a lot of other issuers have the same. And so I would just encourage everybody to really work with those capital markets desks to really understand what it's going to cost you to buy and sell the ETF that you're interested in, and understanding the liquidity of that particular ETF, because it's not just about volume and size. The liquidity of that ETF is a function of that liquidity of that underlying.
Great points. I would just like to add that when markets are volatile, investors should use limit orders. Now,
Yeah. Very, very good point.
okay, switching gears a little bit, Gillian, you're also co-founder and global co-president of Women in ETFs, a fantastic organization, which I'm sure you must be very proud of. And last month, we celebrated the 5-year anniversary of Women in ETFs here in Chicago. So talk to us a little bit about the organization.
I'd love to. One of my favorite topics.
Mm-hmm.
So, yes, I'm incredibly proud and honored to be the co-president globally of Women in ETFs right now, actually coming up on the end of my 2-year term and trying to figure out what's going to come next as I try to continue to give myself to the organization. And actually, I was just in New York this week, and we celebrated the New York chapter 5-year anniversary on Tuesday as well. So incredible turnout. But the organization really was created as an outlet for women and men. 20% of our organization is actually made up of men, and 40% is actually outside the United States. So we truly are a global organization. But was created as an outlet to help support, connect, and inspire those of us that sit within the ETF ecosystem. So that's issuers like myself, index providers, market makers, traders, consumers of products, advisors, et cetera. There's so many disparate pieces of this ecosystem, but we all are fundamentally connected. But yet there was no place for all of us to connect together. And so here we sit 5.5 years later. It'll be 6 years coming this January. And we're at 5,200 members on 5 continents and 12 countries. So I think that it's really just proven that there was really a need for this outlet. And one of the things that makes me so proud, and I know you've been involved in some of this yourself, is that we don't just talk about taking action, we do take action. So things like creating our Speakers Bureau, where we observed a gap in the industry, that despite women in the industry, we were seeing a marked gap in our representation on industry panels and in the media. And so created the Speaker Bureau to help solve for that, and gained commitment from the industry conferences and our media partners to really tap that list, and they have, in order to diversify their panel discussions and their discussions in the press. Or something like university outreach, where we engage with 27 universities across the country to try to help, inform students about, the ETF industry and what it is, and try to help start mentorship really at some of these young levels, and inform curriculum within the business schools. So incredibly proud of the action that we're taking. Something I'll end just on one thing that I'm incredibly excited about doing again come March, and that is continuing to push for inclusion and equality. That fight never ends. And we've partnered with organizations like the UN and Sustainable Stock Exchanges to do, on International Women's Day every year since 2015, ring the bell for gender equality. And in 2019, this past March, we actually rang the bell on 75 exchanges around the world in support of inclusion and equality. So just a few things that we're doing that I think really do illustrate the action that we want to take to have an impact on this industry. And our work is not ending anytime soon. So certainly welcome new members, new volunteers to try to help us take ourselves through the next 5 years.
Yes, it's a fantastic organization, and anyone wishing to get to be involved or to learn more about the organization should visit womeninetfs.com. That's all we have time for today. Gillian and Alex, thanks again for joining us.
Thank you, Nina, so much.
Thank you very much.
Thanks for listening. If you want to learn more about these ETFs, please visit am.jpmorgan.com. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@saks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.